Welcome to another episode of the F Word, where we speak about finance and the different questions that we get from clients. And Fransja, for us as Bovis, we're completely independent, meaning we can invest our clients' money basically anywhere. So many different options. So what we do on specifically this podcast today is we invite one of the asset managers, 361. We'll get to their name now and how they chose that name. But they've got the normal unit trust side, so they're long only, and then they've got the hedge funds as well. And I must say, on our previous videos on hedge funds, we got a lot of interaction, still a lot of questions. So we do see hedge funds specifically as a topic of discussion that people want to talk about, and that's also what we're going to go into more detail today. But Fransja, it's nice to have you here again joining.
Thank you.
And then we also have Ruan Janse van Rensburg from 361. Welcome.
Thank you, guys.
Good morning.
It's great being here in Stellies. I enjoy the drive all the way from Durbanville. It's always nice coming to Stellenbosch. You've got nice offices.
Lots of traffic, not a lot of parking, but but I must say again, we're outnumbering Fransja because we went to the same school.
Was it always a school thing with you guys?
Just had to get that in.
Get it out of the way.
Representing. Now, welcome, Ron, 361. Give us quickly who you are, when did you start?
So 361 Asset Management, we've been around 20 years. It was started in 2004 by Stephen Lips and Cy Jacobs. They've actually worked together since the 90s, so the two of them been working together 30 plus years. And we've got a quite smallish team, 26 people in the business. That falls into the investment team part, your portfolio managers, your analysts, and then the operational side. What makes us a bit different, we've got our long-only funds, as you mentioned, and then we've also got the hedge funds. So we look a bit different to funds and markets than your typical long-only manager. We always talk about the hedge fund mindset. With hedge fund mindset, it's also about avoiding potholes, always thinking, avoiding the next big crash, downside protection, that type of thing. And that just filters through to our investment process and everything we do.
Yeah, just quickly back to the name 361. So we know a circle is 360 degrees, right? So you said we'll take it one extra degree. That's basically you taking the extra step. Is that
spot on? In a nutshell, the conventional circle is 360 degrees. That's full view. The name 361, it's just the extra degree, going the extra mile. And it filters through to our culture and our DNA, everything we do, whether it's with the portfolios or our client servicing side, just going the extra mile and doing that consistently.
Yeah, and you just quickly mentioned you're a small team in terms of number-wise, but just assets under management?
Yeah, we're around 60 billion now.
Not a small group.
we still, interesting part on the AUM, if we look at the last 5 years, our AUM growth, we've actually 2/3 of our AUM growth came from market performance. So that's actually our funds performing, and 1/3 was inflows, net inflows. So and I think that's, if you look at the hedge fund managers and the hedge fund mindset, it's all about performing. Like if we don't perform, then the client's going to take their money and give it elsewhere. So we are really driven by performing, and we are incentivized to perform. And all the returns we give to clients is also always net of fees. It's very much a performance mindset.
So I'm just going to shoot out of the hip from the start, because we get this question a lot. How risky are your funds, and what are the possibilities or odds that a client will lose his or her money totally?
Like a Bernie Madoff or...
A Bernie Madoff type situation. And we'll get to that a little bit later with the reporting and all that stuff. But sometimes it feels as if hedge funds are a little bit secretive about the positions that they take, the companies they invest in. So what are the odds of a total capital wipeout for a client?
So when the normal retail client hears about hedge funds, it's about risk. They're taking a lot of risk. It's back to that, they saw it in the movies, it's high risk, Wolf of Wall Street type of investments. But perhaps not.
If you think about the hedge fund, it's actually in the name hedge. It's to hedge yourself against the risk, to delever yourself. So that's actually, it says what it does in the name, firstly. If you look at firstly, secondly, not all hedge funds are created equal. I think in South Africa, it's important to also look at the manager, look what they're trying to achieve. Some managers with their hedge funds try and maybe give equity plus like returns, where some other managers like ourselves, we want to give you market like returns, but with great risk metrics, cash like volatility, that type of stuff. So on risk, thirdly, risk is measurable. So if you can look at stuff like maximum drawdown from peak to trough, you can look at sharp ratios, Sortino ratios, all that stuff. And if you look at 361 in our house, our hedge fund is our least risky offering actually. It's less risky than our flexible fund because we can use stuff like index protection, we can buy puts. There's certain stuff we can do in the hedge fund that we can't do in the long only side. So to answer your question on how risky is it, in our case, it's actually our least risky offering. And then the second part of your question, what's the chances of total wipeout and all that stuff? Very importantly, if you look at the CISA category, in 2015, 2016, retail hedge funds came in as part of the Collective Investment Schemes Act. So it trades as a normal unit trust. Okay, daily liquidity, similar on all the lists. So it almost became like a normal unit trust as we all know them. And if you look at a CISA, they limit the hedge funds to 200% gross exposure. So you can't go more than 200% gross exposure. And if you think about all the funds that blew up, it's typically qualified hedge funds in the US where those gross exposure limits are not there. So some of those guys would have been 500, 600% gross exposure. So that creates a lot of leverage. And when something goes wrong, you'll blow up. So that limit is there in South Africa. So that's a huge benefit for investors. And in the case of 361, we typically range between 90 to 110, 120% gross exposure. So we don't even go close to that 200%.
I think maybe if you can, just for the common man out there, explain what gross exposure is, okay, and the leverage is. Sure. You spoke about index protection, put options. Maybe if you can simplify that, because all of these words can be very scary to people.
And jargon, it's jargon.
And sometimes jargon people are fearful of jargon. Yeah. And sometimes I see it as sort of deceitful, people trying to mask some activities. So maybe
it makes you sound smart, but the client maybe doesn't understand.
Yeah. So maybe if you can explain to us gross exposure.
And just to that point, because we tell our clients, you kind of need to know what you're investing in. Don't just invest in anything. You need to know what you're investing in. And hedge fund is quite difficult to explain to them. I mean, because just back to that point is you've got your 4 unit trust funds and they are aggressive, moderate to aggressive, but then you've got your hedge funds, which is, like I say, lower risk, yet you've got the return of 15% over a long period of time. How do you do it? What are the put options and all of that? Maybe just explain.
Great question, guys. Firstly, on gross exposure. So how do you create leverage? Leverage is when you maybe go to a long-term investor like a pension fund. They sit on a lot of Standard Bank equity, and the plan is that they hold that for a long time. They don't necessarily want to trade. So we as a hedge fund manager, we can go to that pension fund and tell them, listen, we actually want to borrow your Standard Bank stock. We borrow it at 100 Rand. And the idea is that we maybe return it to them at a lower price, maybe at 80, then that would be good. But when you borrow that stock, you create leverage. Because I'm borrowing someone else's stock now. So now my net asset value in the fund is 100, but now I borrow 10 from Standard Bank, so I create leverage and my gross exposure goes up to 110. And the thing is, if you short or use leverage, you also must do something with that capital. So that's why being a hedge fund manager and shorting is actually a very particular skill. That's very different than just the long only side, because now you need to short and you need to decide, what do I do with that capital? Do I park it in cash? Do I use it for some other trade? So that's just on the gross exposure. And to answer your question, we try and give you market-like returns with cash-like risk. That's what 361 Retail Hedge Fund tries to achieve. And there's multiple levers we pull. Our focus is on the SA equity market. That's where we specialize. So we use long-short equity trades. And there's a couple of stuff we can do here. Like we talk about shorting. So we typically, most of our short trades is actually part of a pair trade, where we'll short a Standard Bank maybe, and then we buy a First Rand. So it's not to say that we short Standard Bank because we think it's a fraud. It's just a relative play. We think maybe that Standard Bank is a bit overvalued and we think First Rand has a bit better value. So relative to the two, we think there's going to be an outperformance from First Rand. And we don't take any market risk on that trade because we do the same amounts. So that's something we do in with the shorts. And the whole mindset of, if you've got 100 Rand and you lose 50%, you go to 50. You mustn't do 50% to get back to 100. You must do 100. Yeah. So if you look at our drawdowns and our risk metrics, we typically, and it's in our stats, like typically we get 2/3 of the upside from the JSE All Share Index, and then with the down months of the ALSI, we're almost flat. So the ALSI on average down months will maybe be 2 or 3% negative, where we are pretty flat. So that's that whole thing of compounding of a higher base, because we don't have that drawdowns. So we actually don't need to give you the 20x return because our drawdowns are very small. So we just keep compounding of a higher base.
Yeah, it just seems like there's so many levers to pull. Like the real expertise of the asset manager really comes to the fore in a hedge fund. I mean, then you really have to know what you are doing. And I think because you are such a smallish team, you don't have that corporate overlay, so they can quicker take action, which is also to a benefit to you.
I think that's 361 where we probably, one of our strengths is execution. We run a flat structure in the business, and every day our investment team talk to each other. They get on calls, and if we see an opportunity, we're small enough to act. We don't have a committee where that gets discussed and then it goes to another committee, and then that's 2 weeks later and the opportunity is gone. And then secondly, we're still small enough that we can actually use the opportunity. We can actually move the needle by playing in, it doesn't take us 20 or 30 business days to build up a position in a company or unwind it. We try to be flexible and nimble. And listen, we also don't get it always right. Like, you can't get it always right. And if we see we may be in a position where it's going against us, we're small enough to change it around and also correct. Yeah.
Do you use AI in that, or do you use algorithms? Can you use it in your hedge fund now, or do you see it as a threat going forward for any asset manager, let's say, or specifically hedge fund manager, or not really? Do you rely on the decision making of the human?
Listen, AI is fascinating. If you look at Elon Musk, Grok, he launched that now on X, and you can ask it what's the fair value on Apple, or what's the sentiment. So I think AI is powerful in terms of information and just putting because the information is so much. So where AI is really valuable for the investment team and guys, it's just like consolidating stuff, that type of thing. But it's not like we don't have a bot where now it does calculations and buys and sells. Yeah, that's still it's the investment team expertise. They do a lot of research, but I think where the AI and tech comes in, it's just more access to information. It makes it easier. Things happen quicker. That type of thing. Yeah.
I'm glad you brought up the whole bot thing, because my social media, I don't know about yours or yours, it's full of bots, active trading, forex trading, all that stuff. And it's becoming more prevalent. I don't know if my algorithm, it's got me now. It's got me. But what do you think about all these bot tradings and?
Yeah, it's wild. Like if you look at the US, they've got quarterly earnings, and it was just this whole month of February, all the S&P 500 companies that released their quarterly earnings, and the volatility you've seen in the stocks is crazy. Like it's 15-20% moves post and pre-earnings, and a lot of that is is just the algos, the algorithms, and the bots. They're so quick on the information. Like if there's a investor update being posted on the company's investor relations site, the bots pick that up soonest, and they can see maybe the earnings is a miss, and they'll quickly sell off. But it's sometimes maybe also overreaction from the bots, and then maybe the more rational sort of investors come in and see maybe, it overreacted. So what the bots and all that stuff does is just, it creates more volatility, short-term noise, which for us as hedge fund managers is great. Like the one thing we know there will be is volatility. And we use that volatility to the client's benefit, because volatility creates opportunities.
So was DeepSeek a good example? And the news came out of DeepSeek, and the Nvidia shares fell like 30% in one day, but it just quickly came back. So that was bots selling off the.
I mean, it was like in hindsight, it was a proper buy the dip, Nvidia. And you heard the Microsoft CEO. He talked about Jevons paradox, where there's an argument that can be made as AI and stuff becomes more cheaper and easier to use, it's actually just going to increase the demand for AI. In other words, more NVIDIA chips maybe. So I think the market just had to work through that and see, what does this entail? It's China. I mean, that's also a different thing. But our investment team are very much focused on also identifying, what's happening in the market, where's the supply and demand moving. We look at all of that stuff. And NVIDIA, DeepSeek was certainly one of the big events this year. NVIDIA's earnings are coming later this week. So it's going to be interesting to see if the big hyperscalers, Microsoft and Amazon and those guys are still buying NVIDIA chips, and if the AI trend is continuing.
Do you have any exposure to NVIDIA or DeepSeek or any type of position there that you can tell me about?
Or did you show it them because they are so expensive? Or?
We used to hold NVIDIA back in the day, and we got out too early in hindsight. But we do hold Broadcom, some of the other chips as well, and we do hold some of the bigger tech stocks. But at the end of the day, 361 is a SA equity specialist. So that's where our expertise lie. And we'll always try and seek first what's the opportunities in the SA market, because we've got access to management. We understand that companies, we've been following it for so long. But obviously in our retail hedge fund, you can go up to 45% offshore. We are not close to that. We typically like to use the S&P 500 for index protection, because the options market in the US is very liquid and the pricing is much better. We diversify. At the end of the day, we diversify across names and sectors.
Yeah, if we just get more practical, who should invest in a hedge fund, and how much should you invest in a hedge fund? I know it's a difficult question, it depends on the person, but one opportunity that we've spoken about just off screen is in a retirement annuity, or in Regulation 28, which is the regulation that define or that's put in place on any retirement money, whether it's a pension fund or a retirement annuity. There's 10% allocation there that can go to hedge funds. Yeah. So you see that as an opportunity as well?
Yeah, we definitely think that's something that clients should be considering to utilize. Although it's only 10%, and they limit you to 2.5% per hedge fund. So effectively, you need to invest across 4 hedge funds to get your 10% up. Although it's small, we do foresee in future that regulation will loosen up, and hopefully over time, as the offshore allocation went from 15, 25 now to 45, we do think that retirement annuities and Reg 28 will loosen over time. So it's definitely something to consider. And then if you look at living annuities, because of the good risk metrics of hedge funds, we talked about drawdowns, downside protection. It's actually ideal for clients that's, selling on a monthly basis or quarterly basis, because you're not selling on that big downturns. The last thing you want to do as an investor is sell when your units went down, because now you've got less units for the recovery. So we do think that hedge funds got a great role to play in living annuities. Just because of the downside protection. And at the end of the day, hedge funds it does give you diversification benefit. If you actually drill down to under the hood, it's uncorrelated to your normal balanced funds, your normal equity funds. And, that's one of the only free lunches in investing is diversification. So I think from a diversification point of view, in addition to the risk metrics, hedge funds do offer really, it is appealing for investors to use it. And then you also get great returns. I mean, over 5 years, our fund has compounded over 15%.
Yeah, I'm glad you spoke about the units, because that's very important and not a lot of people understand that, especially at retirement. Maybe if you can delve into that, because how I understand it is, say a person wants to withdraw 200 Rand per month. You bought the unit trust at a unit of 200 Rand. So now it sells off one, right? But now the movement goes down, it's down to 100 Rand. Now you need to sell off 2 units to get to the 200 Rand. Why is a unit so important?
I mean, you've explained it really well, but we do understand that units matter. And, it's like, think if you buy 100 shares and now it goes down, you don't want to sell your same 100 shares at a less price, because now when the recovery comes, you've got less shares to participate, and it's going to take you longer to reach that. So yeah, it's just like the units matter, and each unit you buy is at a certain price, and you actually want to sell as less units as possible, especially in drawdowns.
So Ruan, we do see a lot of mistrust or distrust these days, especially when it comes to performance. Everybody gets told, we can give you 12%, 20%. I've even heard 33% the other day. But I think there's a lot of, misinformation floating around and people taking a lot of risk that they don't even understand. But on your side, are you guys regulated? And, how do we know that it's not a Ponzi scheme or somebody stealing money in the background? Yeah. Do you guys have the proper structures and reporting in place for something like that?
Yeah, great question, Francois. So one of the first things to remember is, if you look at a unit trust on a hedge fund, there's actually some processes in place which ensures that stuff won't happen. So firstly, we've got an administrator that administrates our funds. They've got a custodian account. So when clients pay money, they don't pay it to 361's bank account. They pay it in the custodian's bank account. So there's a separation between manager and the actual administrating of the funds. If you look at the Madoffs and those guys, there was no separation. The fund and the bank accounts and administration was everything one thing. So he had access to the bank accounts, could move money in, move money out. We can't do that. It's like clients don't pay money directly into Bovest's account or Hugh or Francois' bank account.
We wish, no. But that's a big, exactly.
There's a separation.
Red flag, yeah.
I mean, that's a first red flag. So always look at, it's just basic, but look that there's a FSP number. Is it FSCA approved? That type of thing. Does it fall under the Collective Investment Schemes Act? Is it regulated? Because in itself, there's already a lot of protection built in. So I mean, and then there's reconciliations that happen on a daily basis. The accounting gets audited. All of that stuff gets done by external people, not 361. And it's not in our bank accounts. It's in a custodian and with administrators. So I mean, a unit trust is one of the more regulated vehicles out there, and I mean, offers a lot of protection for investors.
Yeah, I think as we wrap it up, if you had one piece of advice or one area where you see opportunities in 2025, because it seems like everybody's positive. Offshore markets are growing with Trump. Locally, we think with the GNU, the valuations are low, there's going to be growth. You should be in equities. Are you as positive? Yeah. And where do you see the real opportunities?
Yeah, I think at the end of the day, we always take a balanced approach. When we think it's an environment to take on risk, we'll do that. And when we think there's a bit more uncertainty, we'll dial it down. There's always opportunities here. There's like markets overreact, something gets overextended. We do think the GNU should hold. It's been through a rough time. We saw now what happened with the budget, but that's maybe good for democracy. I think democracy.
Yeah, it's actually good. Some people see that, but it's good. It shows you that the DA also have a voice.
Exactly. And then I mean, we are optimistic about equity markets in the US. If you look at the earnings season that just went past, most of the companies beat earnings expectations. The economy looks strong. There's always going to be a Trump tweet tomorrow or today that's going to ruffle the feathers, but it creates opportunities for us because there's going to be volatility. So the one thing, I've said it before, but the one thing we do know is that there will be volatility, and that creates opportunities for us, especially if you're able to move in and out and utilize that opportunities.
The riskiest thing you can do is to de-risk completely, because then you miss out on all
I mean, then you're not going to outperform inflation or cash, because that's the ultimate enemy is inflation.
Thank you. Thanks.
Brilliant. Thank you, Ruan.
It's a pleasure.